Would you rather the money in everyone's hands become worthless paper, or would you rather everyone lose their jobs at the exact same time? If you choose the first, your savings evaporate. If you choose the second, your ability to earn an income vanishes. Stagflation is the scenario where the economy forces both of these pains onto the public simultaneously. Look at global crude benchmarks for early 2026. In 3 months, prices surged 85%, pulling the price of everything else upward. Simultaneously, US payrolls fell into negative territory. As costs spike, companies are conducting sweeping layoffs. Traditional advice suggests buying the dip or holding on to cash during a crisis. In this specific cycle, those strategies face a direct collision between rising costs and a disappearing income stream. Many people feel wealthier because their nominal salaries have increased over the last decade. But if that same starter house now requires decades of crushing debt, your actual purchasing power is hollowed out. Navigating this requires a methodology built for these exact conditions. That's why I founded the Stewardship Finance Academy, to provide the technical logic needed when the old rules no longer apply. You can access our current research through the SFA Free Stock Investment Masterclass. Use the link in the description to secure a spot. Without a strategy designed for this environment, the gap between what you earn and what things cost will continue to widen, regardless of how hard you are working. This happened before in the 1970s. Middle East oil shocks sent inflation past 13%, causing the price of basic goods to double in months. At first, the Fed hesitated. Businesses were squeezed by rising wholesale costs and falling demand, leaving them with one option: mass layoffs. The cycle only broke when Fed Chairman Paul Volcker hiked interest rates to 20%. He made borrowing so expensive that consumer spending effectively halted. This intentional recession was a brutal medicine. It pushed unemployment past 10%, but it successfully saved the currency from a total collapse. Today, the government cannot use that playbook. The single variable making the 1970s cure impossible is the national debt, now sitting at $39 trillion. If the Fed applied a 20% rate today, annual interest payments would hit $7.8 trillion. Compare that to the total tax revenue of only $5 trillion. The interest alone would exceed the country's entire income. The Fed is pinned. Attempting to crush inflation with high rates would trigger a sovereign default on a scale never before seen. This introduces a strategy known as debt dilution, the choice to maintain high inflation to erode the real weight of that debt over time. By allowing inflation to run between 5 and 10% for a decade, the real value of that $39 trillion burden is halved. This persistent inflation functions as a tax, siphoning value from private savings accounts to reduce the government's public liabilities. There is a unique paradox here. The dollar buys less at home, but stays strong internationally. Because the US is now a massive net exporter of energy, global buyers must secure dollars to participate in the market. To protect yourself, you have to use the same logic as the government. Borrow fixed-rate, long-term capital to acquire tangible assets. Inflation makes the real weight of a fixed mortgage payment smaller every year, while the physical property benefits from rising rents and higher nominal valuations. Holding cash during this wealth transfer makes you the source of the funding. Holding fixed debt attached to a productive asset makes you a beneficiary of the mechanics. Beyond real estate, the focus shifts to raw commodities. Consider copper. The global transition to new energy grids requires millions of tons, yet mine grades are collapsing and supply is falling off a cliff. While physical gold is a common refuge, it lacks a yield. A more resilient move is owning shares in energy producers and agricultural assets that pump cash and pay dividends, while underlying products grow more expensive. Warren Buffett's current portfolio reflects this reality. He maintains a massive reserve of short-term T-bills for yield and liquidity, paired with heavy stakes in oil producers and global trading houses. This model prioritizes assets that yield cash during high inflation periods, while keeping enough high-interest liquid reserves to act on market dislocations. This cycle represents a multi-year shift in how the global economy functions. Waiting for official confirmation from the news often means the opportunity to position your capital has already passed. If you want to see the specific data points and entry signals we track to navigate these moves, join our SFA Free Stock Investment Masterclass. Click the link in the description below. Understanding the board as it sits in 2026 is the only way to protect your purchasing power and grow your capital. Stay vigilant, and I'll see you next week.